Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with my 39th guest, Ian Duncan MacDonald. Ian, go ahead and tell the people a little bit about yourself.
Okay, I am an author. I've written 9 books. 6 of them are investment books. All of them deal with dividend investing. 3 of them are novels. I'm also an artist. I've got 3,000 paintings, photographed, digital art, etc. on Fine Art America. And I've also a podcaster. And I just did my 154th podcast called Safe Dividend Investing, which is available on almost all podcasts. I'm a former vice president of Equifax, a senior vice president of Creditel of Canada Limited, a former senior executive in charge of all marketing and sales with Dun & Bradstreet. I'm a graduate of McMaster University, and I was just reading something from many years ago that said that I did not think that I would ever be successful in business. So I guess everybody can be wrong about where they're going to go. My whole background has been in commercial risk assessment. I've got almost 40 years of experience doing it, everywhere from being a commercial credit reporter for Dun & Bradstreet, going out and interviewing businesses from small people working out of their garages to multi-billion-dollar mining companies and so on. And so, yes, I know a lot about commercial risk. And that is how I got into dividend investing.
Well, that's a heck of an intro right there. How did you find time to do 3,000 pieces of art and podcast and everything else as busy as you've been?
Because I work long hours every day for very little money, but I do it because I enjoy doing it.
Yeah, that's super cool. Wow. All right. So out of curiosity, this isn't a scripted question, but out of curiosity, have you ever went back to your very first podcast episode, and does it make you cringe with how likely not great it was? Because I do that with my first video.
That's right, but your format is quite different than mine.
Yeah.
With mine, I'm writing my script out and I'm dictating it. So, and also I do very careful editing so that they come out more or less perfect.
Yeah.
There's no any pauses and pauses and,
Yeah.
and weird noises and so on. So no, they're fine.
That's
and
good.
I answer 2 or 3 questions, sometimes one question, one major question, in each podcast. They go on for about 20 minutes.
Yeah, I was listening to one this morning while we were waiting, and I was listening. It was there was 3 questions in there, and one was really interesting about like when you sell your holdings and stuff like that. So we might get into that in the interview. So okay, so first question for you is going to be, when did you begin investing, and then what got you into the dividend side of investing specifically? Like, did you start with dividends, or did you kind of wander your way into dividends after so many years?
It's an interesting story. I was senior vice president at Creditel, Equifax. I learned secretly was going to buy us out. I was the youngest of probably the 4 senior executives. They were all 10 years older than me. So I was 52 and they were in their early 60s. They wanted out and they wanted to get the money out. So I didn't have to worry about investing or dividends or anything like that. I had a index pension fund, which was 80% of quite a very good salary. And why would I have to worry about money and saving and that sort of thing? All of a sudden I'm told, hey, your job's over. We're going to give you a payout instead of a pension. Here's a big lump sum of money. What are you going to do with it? So I went to a friend of mine. Actually, he was a friend of a friend who I knew who owned a small securities company. And I walked in and I had this check and I told him I needed to invest it and could he help me? Of course he could have helped me. Definitely he could help me. So he put all the money into mutual funds. And 15 minutes later, I wrote the largest check I'd ever written in my life and I walked out. And I thought, well, there's one thing off my to-do list. I don't have to worry about it. He told me, I did ask him. I had the wisdom of asking, how much is it going to cost me? And he said, oh, it'll be so little that you won't even notice it. I said, okay. And how will I get my money out? Well, it should last you well until you're 90 years of age. And then you'll just be, as you go along after you quit working, you'll just liquidate 4% of the mutual funds each year, and this will last you for the rest of your life until it runs down to zero. I thought, okay, that seems fine. So I go home. I got hired by Equifax then as a vice president to handle the transition between the two companies. So I'm working away there. I'm not particularly happy at Equifax, but I work away there for 9 more years, and I'm coming up to 60. And at 60, everybody gets booted out at Equifax, it seems. So they say, well, it's time for you to go, sort of thing. Great, I've got my money there. But I'm looking along, and before I got there, I noticed that the money that I had put into this guy had now shrunk down to about maybe 60% of what I had given them. And that was hundreds and hundreds of thousands of dollars that I am now short. And I said, this doesn't make any sense. And I thought to myself, I can't do this anymore. This money will never last me. So I'm going to learn to be a self-directed investor. So I start my education. And one of the things I found out, or at least suddenly occurred to me, here I've been assessing businesses for the last 30, 40 years. I designed scoring systems for banks who, when the major banks took it and tested them, said they were amazingly predictive of predicting where they were going to be showing their bad debt write-offs. So I said, okay. Suddenly occurred to me, a company, a stock in a company is just another company. That's all it is. It's just another form of commercial risk. I'm not interested in getting rich and having billions of dollars coming out of the stock market. I just wanted to preserve my wealth, see it grow nicely, and give me a nice, steady income, a dividend income. So I sat down one Sunday afternoon on my kitchen table, and I designed a scoring system. Same way I designed the scoring system for the banks years before to do risk. And I came up with it. And what I wanted to get was an objective picture of a company so that I could take thousands of companies, sort them out, and then sort them from highest to lowest, and then end up with the 20 best companies I could possibly get that were going to be financially strong so they would survive, and that they would also be able to give me a high dividend income. I was looking to get over 6%. Usually I average about between 7 and 8%. And I also wanted them to have a capital gain, which is where the strength came up. Mm-hmm. What you find interesting with businesses, with the scoring system, is those that score high for strength and so on usually don't pay that high a dividend. Mm-hmm. So what you've got to do is balance the strong ones with companies that don't score as high, but they're paying a much higher dividend. And some of them can score, 9%, 10%, 8%, which will then take those that are scoring 4 and 5% up to the average of 6% or whatever. So I did that. And I sat back and I very quietly built my thing. Why did I decide on 20 stocks? Because I figured that I could afford to lose, if I'm generating 6% in income, I can afford to lose 5% if one of the stocks turned horribly, horribly bad and I lost it, because I'm generating enough income from the other stocks that it would offset it. And gradually the thing grew. The $300,000 I lost initially, I made up within a couple of years on net gains in the stocks that I had chosen. The income I got, it gave me a steady 7%. It grew well over $1 million. And then I took my wife's investments, and I did the same thing with her. So we make a very tidy income. And the strange thing is that that high scoring stocks in my books, I go back and I show the stock price and I show the dividend payout going back for 25 years. You are able to pick out stocks that have shown constant gains in price and in dividend payouts. The interesting thing is the dividend payouts grow faster than the share prices usually.
Mm-hmm.
Speaking as a former executive in a public company, the last thing that we thought about or cared about was the share price. What we were concentrating on was making our revenue budgets and our profit budgets. And what runs the companies are the executives. They're the ones making those decisions. It isn't the shareholders or the people buying the stocks out there. The fact that you try to influence the shareholders by showing a strong, steady company, yeah, it works, but really, you take pride as an executive in seeing your company strong and healthy. So I want strong and healthy companies to invest in.
Mm-hmm.
The other thing is I am old as dirt. So I've seen companies come and go over the years. I remember seeing one guy that I called on, let's say in my 20s, who was just starting off. He had kind of like orange crates for a desk and this sort of a thing. In 3 or 4 or 5 years, he's now into beautiful offices and so on. I've seen those guys just start off a business in beautiful offices and they're gone within another 6 months or so. Mm-hmm. I've seen companies that were multi-billion-dollar companies disappear in my lifetime, which I never thought would ever have been possible. So when I see Tesla and McDonald's and all of these, and I look at their book values, and I was looking at McDonald's the other day because I have a reader in Dubai who is bringing it up to me. And, McDonald's is selling for $250 a share. The book value on it is minus $2.05. McDonald's is a big, strong company, and I've had many dealings with them over the years, and I know they're a strong company, but that turns me off. I don't want a company like that. Mm-hmm. The other thing is they're not paying a dividend of any sort. So any of the Magnificent Seven that you see have no interest to me whatsoever because they don't pay dividends and they're overpriced. And I don't like that. I'm always looking for stocks that are in $10 to $20 range. I've even got some that are in the $4 range that have then multiplied up into the $24 range. Those are the ones I look for. I'm not interested in what's being said in the news. I don't really care about share prices very much. To me, it's the strength of the business, the operating margin, the book values, and the trend and the historical trend.
Yeah.
What else do you want to know?
No, I'm really glad you said that last part. So one thing I did want to bring up is that you mentioned that so McDonald's does pay a dividend. You might have been I know you mentioned McDonald's and Tesla. So Tesla does not pay a dividend.
No, it doesn't. I think McDonald's does, but it's maybe on a $250 stock, it's like $2.
Oh yeah, their yield's probably in the mid twos somewhere.
Or I can spend $10 and get $2.
Yeah. So I mean, that's the thing. And I feel like I don't own McDonald's. I used to own McDonald's a long time ago, but I feel like McDonald's is almost as much of a real estate play as it is like anything else because McDonald's, the amount of real estate they own is ridiculous.
Absolutely.
So
it is.
That's one of the things that people don't even they don't factor that in when they're considering or not considering that company is like, what assets do they actually own? Now their ice cream machines, I wouldn't recommend investing in those because they're always broken, but their real estate is something different. But the last thing that you said, and you're not going to get any pushback from me. I am interested in like how you came. So a couple questions from what you were just talking about. So the thing that you said that does resonate with me is that stock price doesn't matter. I've been saying that for a long time, and I specifically believe that for the people that do have longer timelines, such as myself. Like I'm 29. I plan to retire at 50, but I don't plan to stop investing at 50. So therefore, if I buy a stock, if I'm buying stocks that are good and high quality stocks, and I have to worry about the fact that they may or may not be the price I spent today, 21 years from now, I'm buying the wrong stocks. Like there should be no scenario where the stock I buy today is anywhere close to the same price as it is 21 years from now. Like that's my first thought. So like I see so many people in like different dividend groups that I'm part of on Facebook where they're splitting hairs over, oh, I want to buy Apple at 163, not 164. And I'm like, does it matter? Like, is that ever going to matter? Like, are you going to care that you have 10 shares at 163 or 10 shares at 164? It doesn't matter. What's really the opportunity cost that people need to consider is the fact that they were waiting for 163. And if it never gets to 163. So therefore, instead of owning 10 shares at 164, instead of 163, they own 0 shares at 170. Because that's the alternative. That's what really happens is people wait for these prices to pop up. They never pop up. And then they never get to own quality companies because they wanted to save 1% instead of getting on hundreds or thousands of percent gains 20 years from now. So like I brought that up a bunch of times. So it is kind of cool to hear you say the whole like stock price doesn't matter as much. Like that's one thing that I like. You really value the good company versus like what the market values the company at right now. Like it'll balance out in the long term to be more than you spent today because it's a good company. Another thing I wanted to touch on that you mentioned. So when you said that you sat down after you lost money with that investor, so two questions on that. Was the advisor that you spoke with, was it just the funds the mutual funds that advisor put you in, or was that like a weird time in the market where a lot of things went down, or what was the cause of the drop that you experienced?
It was a bit of both. It was a weird time in the market where things had fallen, but it brought home to me the reality that if I am going to live off this investment, or by selling off 4% of it a year, that meant that every year I was going to be shrinking the value of it, and there was no income to cover it.
Mm-hmm.
In other words, you have to liquidate your asset, and to me that just doesn't make any sense at all.
Mm-hmm.
Like, I don't want to do that. And then there's people, I keep hearing people say, well, how can you possibly live off a dividend income? You must have a lot invested. Of course I've got a lot invested, but I can live off it. I'm not, I own 3 cars. I doubt if I've owned these cars since they were new. One is 21 years old. One is 11 years old, and one is a little older than that, which my daughter drives. But I'm not interested in buying a new car. I live in a big house. I don't want to have a bigger house. I've owned boats in the past, and they are a pain in the neck after a while. Either you're storing them and paying for storage or whatever it is. I go on trips. I spend usually a couple of months down in the Caribbean every year. What do I care about? I've got more clothes than I can wear. I've been married to the same woman for 55 years now.
You got everything you need.
What more do I want?
Yeah.
So then people say, well, why do you do all these writing, all these books and these podcasts? Because I enjoy the topic. It's interesting.
Yeah.
I find it interesting.
Yeah.
And I like the challenge.
Yeah, no, I agree with all that. That's pretty cool. So the last question I have on your introduction is, like, you said that when you lost $300,000 off of your mutual fund investment, that you sat down on a Sunday afternoon and you wrote out the plan that you were going to do, where you learned your own investing style. You learned about so kind of the question I have with that is, like, did you just say, hey, what is investing? Like, what do I need to do? Like, did you come into it like knowing nothing, and you kind of sat down on an afternoon and kind of was a big study, and like that trickled into dividends? Or did you already know a little bit and like you knew dividends was the style you wanted to do, or how'd that work?
No, it wasn't really like that. See, when I would be designing commercial risk scores for banks and so on, I'd be looking at things like how long have they been in business? How quickly are they paying their bills? What writs or judgments have been issued against them? What NSF checks are there? What are their suppliers saying about them? Et cetera, et cetera. So it's a question of, I had to set up a system for commercial risk, where I had to set up a system of feeding the writs and judgments of every written judgment in every courthouse in Canada into my database of 2,200,000 businesses. It took me years to set that up. But, I've been doing this for a very long time. I had to get all the collection agencies to give me information. I had to convince thousands and thousands and thousands of businesses to feed me their age trial balances every 90 days. But I built that database, and it was probably at that time one of the best databases of its sort in the world. So when I came to writing the scores on it, I knew the data that was in there, and I knew what was bad and what was good when it came to information. So when I did the same thing, when I said, okay, I am going to choose stocks, what do I want? I recognize that dividends are paid from profits.
Mm-hmm.
If a company is not paying a dividend, it doesn't necessarily mean they aren't profitable, but if they are paying a dividend, it probably means they are profitable. I want profitable companies, so I want dividend paying companies. I don't care about what their potential is and where they're heading and
Mm-hmm.
how they're going to be multi-billion dollar companies. I grew up in the mining industry in a mining town way up north. And they would always be these holes in the ground where, oh yeah, there's gold down there, and invest your money and get your gold out, and you're all going to be filthy rich. Then when I ended up working for Dun & Bradstreet, one of my jobs was selling mailing lists and phone lists to stockbrokers who would be on the phone, phoning all over North America, peddling what they call moose pasture mine stocks. Just nothing. There was no operating mine there at all. And I was supplying with the mailing list. I made a lot of money as a salesman selling that. And of course, then I found out a lot of them were crooks and they were doing all sorts of things. So, okay. So I wanted dividend companies because they're strong. And I wanted financially strong companies that were going to survive. And those are, when I designed the system, there were 9 elements, 9 to 11 elements, to how you count it, that I was measuring, such as the price of the stock now, the price that it was 4 years ago, the book value of the stock, compared to the share price is important, the dividend percent paid, and then I took into consideration what the analysts were saying. Analysts buys and strong buys. They counted on. Then I took the operating margin of the business and the price to earnings. And I scored them and came up with a number for each and put it in there, and I did it. Unfortunately, I was doing this for myself, so I had to test it myself. And it was giving me what I wanted. It gave me an objective number so that when I took a list of stocks, I would first of all use a selector to go through and pick, say, all the companies that had dividend payouts over 3.5% yields. I would pick that, and there might be 100 of them or whatever, and I'd whittle it down. I might end up with 50. Then I would score the 50. And out of the 50, I'd be able to sort them from highest to lowest. And then it became easy. I want this one because he's got the best deal in the fact that his dividend is high and his history is high and so on. And then it was easy to go through using the numbers to sort out the stocks. So you didn't have to spend weeks doing this or months or whatever. It took me minutes or hours to build a portfolio of 20 or so names. And then I start using it, and I'm working. It's working along, and it seems to be working fine. I regained all the money that I'd lost on the mutual funds, and I've got a good income coming in. I'm not working anymore, and so on. Then I get a phone call. I had been a leader of what would you call it? A pressure group. There was developers trying to build, 4,000 apartment buildings on 10 acres of parkland, in which I did not think they should be building on. So I led a group of hundreds of people to oppose them. Now that I met a woman who helped me. She was 80 years old, and she contacted me and said she had been successful. She'd owned 5 gift stores. She had sold them, retired, had the money. She'd gone to the investment advisor and said, all I want out of this is $35,000 a year to live on. And of course, He made sure she got 35,000 a year, but the $1,300,000 she gave him had now shrunk down below $1,000,000. And being 80 years old, she's worried that she's going to be running out of money. She asked me to take a look at it for her, which I did. And that was an education to me as I found out what he was doing. He was selling off the stocks every month to give her the money that she needed. He was making more trades in a month than I would make in 10 years. There was all these funny little charges and so on. And the thing was running down and running down. So I taught her how to be a self-directed investor, concentrating on dividend stocks, paying high dividends that were financially strong, and to using the stock scoring system. Up until then, it was just going to be something for myself. And she started to use it. And she regained all her money. And she's now making over $70,000 a year. And she's now about 85, I guess, now, as the years have gone by. And I still talk to her every now and then. It took her a long time to believe that she could believe in the numbers and what she was seeing, and that all the money wasn't going to disappear on her overnight. She used to phone me every couple of days. What do you think about this one, that one? I never hear from her now. She says she sometimes forgets to check on it for weeks at a time because she expects the money to roll in, and the dividend income does roll in, and she's happy. And she's also became more of an artist, and she's got her art at Fine Art America as well. So, just because you're old doesn't mean you're half asleep up there,
Yeah. Yeah. I mean, I that's a really cool story that the fact. So was the, do you know what paper trading is?
I can probably guess. Is this where you're not really trading anything but paper?
Basically it's just like pretending. So like you can go on a paper trading, like some brokerages have it and then some apps have it where it's like, okay, you start with $100,000 and then you can use that to like pretend that you're buying into certain companies and stuff like that, but you're not really. And it's a way to test strategies and stuff.
Well, I've gone one beyond that. If you go to my podcast number 154, you'll read about a contest, a stock picking contest.
Oh, yeah. Okay.
And for that, I created a spreadsheet. And in it, where you list the 20 companies, you've got a $200,000 budget. So you're spending the money on each of the stocks. And the contest runs for a year. So you got that. You've got the original starting price. Then you're showing each month the dividend income coming in. And the purpose of the contest is at the end of it, who has picked the stocks that have given the best capital gain and the most income out of that. So I'm very curious. So very few people are interested in doing that much work, but I've got a few that are into it. So I've got one of the readers that I've got is in Dubai, and he's teaching his 14-year-old son how to invest, and he's using my books in this stock picking contest to teach him. So he's a teacher by training. And I thought, if you're going to start, I'd want to start training people when they're 14 years old. Mm-hmm. Just before they really know anything, that this is how you can tell that a company is strong or not strong.
Yeah. I literally saw that on the episode I was listening to before we got started. I don't know why I even asked the paper trading thing, but the point of the question is like, do you think that some financial advisors out there almost treat? So in the example of the lady that you talked about that was 80 years old, it's almost like they treat it like they're paper trading. Like they have this exorbitant amount of money. The requirement that the lady set was so low that she just wanted $35,000 a year in income. You could almost do that on accident.
Yeah.
So like that guy's just over here like, oh, I'm going to try this trading strategy because I know I can get her $35,000 in a week. That's easy. So like, I'm going to try all these things. And if they lose money, it's not their money that they're losing. And a lot of people like you were talking about, they don't even know what's going on. Like they're just told, and like you were when you first started, you were just told, hey, we can do this, no problem. And until you started like actually looking at it like, oh crap, this isn't working the way it was. Why am I losing money? Like until you actually have the mental wherewithal to even look at it, that's when you start finding out like this isn't working. So like some people don't ever get that. They never get that little, the little Jiminy Cricket in their head where they're like, hey, like something's wrong here. Like make sure you go check it out. Some people never do that. So some of these people, these investors, I feel like they're like almost paper trading with your money.
Well, the other thing is that they're told that, well, that's just the way the stock market is. It goes up
Yeah.
and it goes
It's risky.
down.
Yeah.
It's risky.
Yeah.
And but just because it's down now doesn't mean next week it won't be up. And so they string you along and string you along. The other thing is that you have to understand the financial advisors. They have only about 20% of their time that they can spend on their existing clients. About 50% of their time is looking for prospects that they can convince to come in. And there are millions of prospects out there that they can convince. You're just one more in the herd that's out there. They don't really expect to keep you for the rest of their lives. Like one of the things that really triggered me you get me thinking back to why I left that advisor behind was that he took me to lunch. And this is the year 2000. And as we're having lunch, he's angry. He's angry because one of his clients who had invested $2 million with him was pulling the money out because he said that the stock market is going to crash. How can this guy be such a fool to say such a thing like that? And I thought, well, that's interesting. So, yeah, 2 weeks later, the stock market crashed. And I said, you know what? The guy that I'm dealing with, the financial advisor, was probably a man in his late 50s, 60s. He'd been in the industry for 30 or 40 years, and he didn't see it coming, but his client did. And I thought, you know what? These guys don't know anything more about what the future holds than I do. They are salesmen. Their job is to separate you from as much as your money as possible to put in their employer's pocket. And that is what it is all about. And if you think it's anything more than that, you're nuts. I remember he would wine and dine me. This guy owned a private resort on an island up in Lake Huron, Georgian Bay. I had about maybe 5 cabins and a big lodge. And he would wine and dine you. He would go out and he had these wine auctions that he would go to, and you were served this fantastic wine and fantastic food and all this sort of thing. And every year I would be invited up there for 3 or 4 days to do it. And then suddenly it occurs to me, well, of course, I was spending enough money with him that I could afford that. Then he had a yacht and a yacht club, and I would be invited to the yacht club for a dinner once a year, a customer appreciation night. So, it's a matter of salesmanship, and this is what it's all about. And the same thing with mutual funds. Mutual funds are marketing vehicles. You read the prospectus on a mutual fund. What will you see? We guarantee you nothing. You have no control over what we are going to invest in. And we can do whatever we want with your money because you have agreed to that. And I thought, this is nuts. The other thing they had is that this fund has 400 businesses in it. I know from having looked at all of the stocks traded on the New York Stock Exchange and the Toronto Stock Exchange, there aren't 100 stocks that I would want to have in a mutual fund. So it's all a great big game to them to make money. They're just commission salesmen.
Mm-hmm. Yeah.
And I ran commission sales forces in the past, and I used to spend about a third of my time arbitrating disputes between salesmen and customers, and all sorts of other people. It was a waste of time, and these guys are just straight money, 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 money. That's what it's all about. Then I ran a similar sales force of 100 people who were all salaried, who got salary increases based on results once a year. It was amazing the difference, and I was able to clean the clock of the other sales force very easily.
Yeah. Yeah, I've seen that. I've seen that a lot with depending on where the primary source of your income is. It really changes like the motives behind what you're trying to do, and that's sad. But
all the cheating and lying and stealing and all that goes on in sales forces.
Yeah,
you've been there because I think you're in real estate sales, aren't you?
No. I do. So I'm in data analytics as my primary job. We luckily don't have any of that. But I've done. I've seen people do like commission sales as far as like I used to be a car detailer. So I worked for like car dealerships, and those are
Yeah,
like commission based car dealerships, and like
yeah,
the predatory loans that some of these car dealerships get people in and stuff like that. It's the same thing. Like at the end of the day, Joe Bob that you just bought a car from doesn't care what your interest rate is or how long your term is. Like they're just trying to get your car payment down to where you feel happy, no matter if you're actually getting screwed as soon as you leave the door and your car lost $10,000 in appreciation as soon as it goes off the lot. Like they don't care about that. They care about the commission because you said yes and signed some paperwork. Like that's what they care
that's
about.
right.
So
That's right.
yeah, I've seen different stuff like that. I mean, it's all the same. Like once you put commissions in it and most of your money comes from that commission, like the morals go out the window, and that's a sad truth. But okay, so next question for you is, over the course of time that you've been doing dividend investing, I'm sure you've made some mistakes. But more importantly than the mistake you made is, what lesson did you learn from making the mistake you made?
I'm sitting here thinking, what mistakes have I made? Um, I made my mistakes before I got into dividend investing.
Mm.
Like right now, I can look at my portfolio and I can see maybe 3 or 4 stocks that are now below what I paid for them. Is that a mistake? No, because when I go through and I score those 3 or 4 stocks, they're still paying high dividends. Their operating margin is still high. Their book value is still high. Their dividend yield's gone up because, of course, as the share price drops, the dividend yield goes up. So why haven't I sold them? Because I don't give a damn about the sales price, about the price of the stock. I'm more concerned about the dividend. So is it a mistake? No. To be perfectly honest, I can't think of any mistakes that I've paid for that. Now, I recognize this, that one of the things I got out of my years of looking and building databases measuring business success is that all businesses will eventually fail and disappear. Whether you like it or not, it is going to happen. And, you've got to be on your toes and be aware of that as a possibility. But the other thing I learned was that when it comes to a financially solid business that is profitable, paying dividends, the chances of that happening this year are not great. It takes a long time for a business that is doing very well to slowly lose space and go over and disappear. I also know from having startup companies that how difficult it is to build a company from the ground up, but I've done it. And when you do it, you do learn that you can take advantage of large, successful companies because they are so rigid in their thinking. They have to keep their current customers happy. And so they are very reluctant to make drastic changes. And so I was very easy to take business away from multi-billion-dollar companies just because I was more flexible and taking advantage of new technologies that they weren't taking advantage of.
Yeah. Yeah, that's a good point. I like that. So I guess from your story, I want to know if you think that this was like a thing that like if you could go back and change it. So you mentioned that when you were with the original company that you were with, that not the original company you were with, the one you first started your story about that got bought by Equifax, that you had the pension plan with them, and it was going to be 80% of your working wages.
Yeah.
Would you consider it a mistake that you didn't try to like diversify that income stream that you were going to have? Like you were fully satisfied with it being the 80% because of the pension, but like you weren't kind of mitigating the risk of like what would happen if all of that went away. Like you didn't have any other sources. Like, do you think that was a mistake, or what do you think about that?
Um, excuse me. I don't think it was a mistake. It was maybe naivety on my part. The company that I was working for at that time was founded in 1910. I joined them in when? About 1976. And I was there for almost 20 years. And I enjoyed it. It was fantastic. I was given almost total, complete freedom to build up my half of the company. I was generating more than half of the revenue and profits for the company in my division. And it just never occurred to me a successful company would disappear. I wanted to expand and go around the world. I did set up correspondence systems around the world for exchanging data with other people. But, just it happened. Did they take care of me? Yeah, they took care of me with as I learned. But no, to get 80% of what was then quite a high salary, it was more than enough for me. I didn't. I'm not. Maybe I'm just not greedy enough. I don't know. But I wasn't interested in being a billionaire or anything.
Yeah. Yeah, I was just curious because it's one of those things where, like, they say hindsight's 20/20, right? Like, obviously now you're like, oh, okay, well, if I would have known that all that was going to happen, then I would have done this. But like in the time, I was just wondering, like, okay, like, would you, like, if had you started doing your investing style that you do today, in addition to that pension, like, it's never a bad thing to have too much money, but it's always a bad thing to have too little money. So it's one of those things where, like, even if you're making triple the amount of money that you would ever need, like, that's when you can start donating it and giving it to, charities and stuff like that, versus making a third of the money that you actually need to live off of. Then you're kind of in a pickle. So it's one of those situations.
Maybe when I graduated from university with a BA, which meant very little, I had $100 to my name. I had worked my way through university in the nickel mines, and now I'm got $100 left. I don't have a job. I was offered jobs teaching. I didn't want to teach, so I hitchhiked home. And I remember arriving home and my father saying to me, "What are you doing here? You're a university graduate." He was a miner, right? So I've got no money. And he said, "Oh, okay, well, you can stay until you get enough money." So then I went back and I worked in the mine. I got my money together. And I then headed down to the big city. And I arrived in the big city and I took the first job offered to me, which was Dun and Bradstreet. And I stayed in the industry for the next 40 years. So, who knows what the future holds?
Mm-hmm.
And if I hadn't had this thing take care of me at Creditel, where all of a sudden they sold out, I would not be as happy now. I would not have learned as much as I've learned. I would not have had as interesting a life. I would never have written my books. I would never have podcasts. So, things happen. You
Yeah.
roll with the punches.
Yeah.
I don't worry about, I think about guys who you're in high school and they say, "Oh, well, I'm growing up, I'm going to be this, I'm going to be that." I never had any plan. I had a brother who was a university professor. And that's all he ever wanted to do. I don't know. Good for him.
Yeah. Yeah. It's the butterfly effect, really.
I still remember him investing money in a guy that was going to convert plastic into oil. It sounds good. Of course, he lost all his money because it's physically not possible to make money that way.
Yeah. Yeah.
But that was the way he thought. He didn't know any better.
Yeah. Yeah. And that's one of the lessons I like to take away from like just my investing journey, and like anybody that's listening, it will be like, you really shouldn't beat yourself up too much. Like, don't beat yourself up on making the decisions that you made based off the knowledge you have today. Like, you have to obviously consider the decision you made back in the day based off the information you had back in the day. Like, you can't look backwards and be like, oh, that was so stupid that I did this. You didn't know the things you know today to now judge that to be stupid. So like, that's one thing I like to like constantly remind myself of, like, oh, I can't, make fun of the way I used to invest because I didn't know any better. Like, that was what I knew at the time. And then now I've learned a lot more. If anything, look at it as like a good thing that now you know enough to say that was a bad way to invest because now you know so much more. So that's actually a perfect segue into my next question is like, how has your investing style changed from when you very first started and you sat down on that Sunday afternoon and created your scoring system to how has it changed now? Has it changed at all? Have you gotten more refined in your process or hasn't it changed at all?
Well, it's interesting. I often get questions like people don't buy just one of my books. They'll buy all 6 of the books. And they'll ask me before they buy them, "Have you changed the scoring system?" No, I can't change the scoring system because if I change the scoring system, I can't compare what something was in the first book with where it is now. It has to be consistent all the time. So, I have my style. One thing that I did do as I went along each book, I tried to make it easier and easier and easier and faster and faster and faster to pick stocks. So when I got into the last one, I've gone about as far as I could think of going. We're now showing 25 years of price and dividend payouts, just so I can see the trends. I didn't have that in the first books, but I think I've learned it's very important. And in those 25 years, I highlight the year 2000, the year 2008, and the year 2020, because I wanted to see how long did it take them to recover?
Mm-hmm.
What were they before it happened? Because we're going to go through another market crash. Whether I like it or not, it's going to happen. And, I am quite happy in knowing that just because the stock price tumbles down does not impact the dividends. I know that because I've studied it and I show that it doesn't. Okay. So from that aspect, I've made it better and I'm not really changing what I'm doing. But I'm still every now and then thinking, well, I want to keep an eye on those stocks, and I do keep an eye on them, but not that close an eye.
Mm-hmm.
It's not necessary.
Yeah. Yeah. And that's the sign of a really good system. And like you said, there is, as far as filtering and stuff, like I have very specific filters that I use. We're actually going to get into, not necessarily mine, but into yours, later in the interview. But like, I think it is important to identify filters that you understand and that are easy for you to use, easy for you to explain, not only to others, because that's not as important depending on what you do, but explain them to yourself. And most importantly, they're easy to follow, because everybody comes up with these wild filters, but then they're just like, oh, I can't remember them. I don't know what they mean. Or like, it doesn't apply to this. It only applies to that. And I'm like, okay, well, that's not really a good filter. You want things that are like as inclusive as possible. And that's one thing I do with my filtering as well. So I do like that you do that. Like you have all 6 books, they all use the same principles. And you're just kind of like building on the solid foundation that you set on that Sunday afternoon. So I really like that.
Well, I'm also told that by people, like if you read most books on investing, they're written by investment advisors and by scholars, and they're very scholarly written. My brother was an English professor. He would write something, and I would have to read it about 6 or 7 times before I understood it. When I was starting off as a credit reporter at Dun & Bradstreet, a commercial credit reporter, I remember going to the editor and saying, how do I say this? And I'd explain what I was trying to explain about a business. And he said, okay, well, tell me what you want to say. I tell him. He says, well, just write it the way you just said it. And I said, okay. So then I learned to write the way I talk. So people say it's like when you read my books, it's like having a conversation with somebody in the room with you that is telling you. At the back of my mind, I've always got that 80-year-old woman where I spent months going back and forth with hundreds of emails, trying to explain to her not only what investing was about, but what business was about, and about how it's important to look at the entire business, not just what the share prices are or whatever. And when I write, that comes through to people. It's very easy to understand. And I get that all the time coming back from the readers. And these are readers all over the world.
Yeah, I really appreciate that too. Because like one of my like philosophies that I tried to make the channel about was just like keeping it simple. Like just because it's deals with such an important thing like your finances and your well-being going forward financially doesn't mean it needs to be complicated. If you enjoy making it complicated, by all means, like there's plenty of metrics to use. You can make it as complicated as you wish. But if you want to keep it simple, you can also do that. And like sometimes these people that make things so complicated and they try to preach everything being so complicated, I feel like they're just trying to convince themselves of something, like they know something more than somebody else does. At the end of the day, how you communicate, or not, I should say what you're communicating matters less than the results it yields. So if your results speak loud, it doesn't matter how you word what you're wording. The results are what everybody's out for. It's not this guy used 7 big words, that guy used no big words. Like you said, just talk to people. The more they understand it, the better they can follow it, the better their results can be, which is the end goal.
Absolutely.
Yeah, I appreciate that. I like that a lot because, like I said, sometimes I feel bad, like when I'm talking on the channel and stuff, like I'll watch other YouTubers in the same space and they're using words and metrics and looking at all kinds of stuff that I have no idea what it means. And I'm like, okay, but like, are their results any different? Like, are my results just as good or better? Like, it doesn't need to be complicated. You can keep it simple. So I like that a lot. So I'm curious this next one for you. So let's say within the next, for the rest of the year, so we're recording this on April 13th. So do you have any short-term goals that you're hoping to accomplish with your portfolio and any long-term goals? So long-term, let's just say, you know, a year or more. And then short-term is between now and the end of the year. Are there any certain goals, milestones, anything like that you're trying to achieve?
No.
Because you're just living life. You're just happy where you're at.
Obviously, the first rule of investing is don't lose money.
Yeah.
And I do not intend to lose any money. I'll keep an eye on it. I don't like where the market is right now. I wish it was about my portfolio was up several $100,000 higher than it is now and has been. But my dividend income hasn't changed. It comes in, it's there, and so on and so forth. Now, my next thing is I like writing novels more than I like writing investment books. So I've got a sequel to one of my novels that I have started, and I'll work on that. It's, to me, writing novels is doing crossword puzzles or doing jigsaw puzzles. Because you've got fantasy and you're trying to make it sound realistic, and it's interesting to do it. So no, that's the only thing that I am intending to do.
Yeah, I mean, hey, it's good for it's your journey. You're living however you want.
I can do what I want.
Yeah, I like it,
and I do.
Okay, so this next one might not apply as much to you, but it's more for like the people that are going to be watching or listening to this. So I want to know. So one thing I always say on the channel is that like the importance of small steps. Like you're not gonna like if you have a 6-foot ladder and it has no steps on it, the ladder is useless. You're not going to be able to get from the floor up to the top step without any incremental progresses in there. So can you speak a little bit on like the importance of like having milestones or reaching achievements in the dividend journey, because it's such a long journey, and like what that does to keep people motivated on the journey?
That's what would I say? It's an unusual question to me. I have money, like right now, I have money coming in that I don't need to live on. So I have to invest it, right? Or I could just leave it in cash or whatever. But usually I still have a lot of cash, but I still invest some of that money and I will invest it. I have to worry about taxes and things like that. And so having the goals in life I believe in, but once you achieve a level of financial independence and it's reliable and it's dependable, the goals all of a sudden don't seem to be very important, because then you can put your thoughts and mind to things that you enjoy doing and like doing, which other people may regard as work, but which to you are fun and enjoyable things to do. I don't think the purpose of anybody is to work all day and all night at something that they hate doing. And I've done jobs like that where I hated the company and I hated working there. But no, I don't have, once you're financially independent, you're your own boss. You do what you want to do.
Yeah.
So does that make sense?
Well, yeah, no. This is like a question more specifically for like somebody that's just getting started on their journey and like the importance of those goals to help them reach the big goal.
Oh, okay. I've been asked that question many times. Like, how would you start? I said the first thing I would do is you've got to save the cash. That's the first thing. I would aim at saving $20,000. And in that $20,000, I would then invest in 4,000 high-paying dividend stocks that are financially strong. And then it would generate dividend income. And as I accumulated the next $5,000, I would add in the next company and the next company and the next company until all of a sudden I would be aiming at having 20 companies with $5,000 each. And then I just keep adding money into it and they would grow. And of course, I know from having done my work and done it that if I'm getting a dividend income of about 6% a year, and I'm showing usually about a 12% gain in capital, I'm doubling the size of my portfolio every 5 years. That is kind of horrifying to people who want to be rich overnight.
Mm-hmm.
But that is one way it's done. And as you go on in time, it becomes easier and easier and easier to accumulate that money to be invested in there because you're not spending it yet. You're looking at your long-term goal, which is I'm going to reach a point like you are at 50 years of age where I can afford to be Ian MacDonald and do what I want to do out there.
Mm-hmm.
Okay, that is what you're aiming at. And it is possible because you're starting young enough to do it.
Yeah. Yeah. And that's really what I try to say when I tell people about like the importance of setting the goals when you're just getting started is like, it really helps you focus on the long-term picture and not really get fascinated with the get rich quick scheme that everybody's trying to do. Is like, if you set these small goals of like, hey, this year I want to make $100. It's my first year dividend investing. I want to make $100 in dividend income. I really don't like income-based goals because I feel like it tricks people into falling for something that we call like yield traps, which isn't necessarily a percentage. It's more like you were talking about before, like the qualities of the company that give you the high yields. So like an example here in the US is like AT&T, I would consider a yield trap because the company, the asset itself has not gone anywhere in value. If anything, it's gone down in value while the dividend yield is still the same or higher, which led, because of all the things that you were talking about earlier, their income that they're creating as a company, their cash flow isn't enough to support their dividend that they had, which is why they had to do a 50% dividend cut. And if you're at the point in life that you're at, where you're living off of these companies and the income generated by those companies, you really, that's the last thing you want is a company suspending or cutting their dividend. Like that really hampers your progress.
I think AT&T is in one of my books, the US book.
As a great company to own?
I just seeing if it's there, if the score would be.
It probably pretty low on the list, I'd assume. I'd hope.
No, I don't think it's there. It didn't qualify.
Yeah, even better. Yeah, so too low on the list.
Yeah.
Yeah, it's just like, I don't know, it's a low-hanging fruit. It's one I always pick on. Like, I don't like the telecom sector in general. Like, I don't like AT&T. I don't like Verizon. We'll see what happens. But okay, so another question I'm curious for your response is, since you are financially independent, how did you figure out when enough was enough? Like when you could finally live your life and do what you wanted to do when you wanted to do it. You didn't have to report to anybody. Like, was there a certain number that hit your portfolio where you're like, hey, I've done it. Like, I'm here and now I can just do whatever. I can write these novels. I can do these pieces of art. I can do this podcast. Like, I can do all these things regardless of what's going on in the outside world. Was there a certain number you hit or a percentage of your income, or how'd that work?
How did it work? Okay, I retire from Equifax, and I've now got to start living off my money. And I thought, well, I can't do that. I don't have enough money. So I said to them, tell you what, I will work as a commission sales rep for you. And they said, okay. And so I started working as a commission sales rep. And then one day, the manager that supposedly I was reporting to, this is less than a year later, started bitching that I wasn't working hard enough. And at that point, I'm looking at my investment portfolio, and most days I'm showing gains of $10,000, $15,000, $20,000. They say, why am I doing this? Obviously, I have reached the point that this is not important anymore. So I quit. I said, fine, thanks, that's it. But it wasn't until that point that I saw the money coming in on the gains every day that I realized that I had enough money because, yeah, it's kind of insecure. You know, all of a sudden you don't have a job. And you've been used to being in a job for all of your life. And then you realize, looking at your portfolio, that you're making more money in a day than I used to make in a year. You know, so why?
Yeah, that it's a question that is I mean, a lot of people probably don't put too much thought in it, especially when they're like really far away from the retirement thing. But it's a question I think about all the time, especially the companies I buy, the criteria I use to pick my companies, the dividend's going to grow exponentially. And it's going to, obviously, with the dividend growing exponentially and my company's compounding, the longer I give them, the more that gets extreme. And I brought it up on several other interviews. It's just like the fact that my year 50, I could make $68,000 in dividend income. But if I wait one more year, which would technically not achieve my goal because I want to retire at 50, but if I wait one more year, that income could go up by 10, 12, 13, $15,000 just because of compounding in the companies I buy. And then one more year, it could go up by another 20,000. And like, that's just how the end of that compounding thing works. And it's just, I don't know. It's just one of those things that a lot of people don't think about. And it was cool the way that you did it. You were just like, hey, this guy, talking to me the way I didn't appreciate it. I just looked at my account and said, I don't need this. And you just left. I like that.
But the other thing is, you're still young yet. I sound like an old man now. That you may be surprised what's going to happen in the next 20 years. Mm-hmm. And you may end up getting into a company and a job that you so totally enjoy that you really don't want to retire at 50. I know I had no intentions of retiring at 50. I was having a ball. I was going all over the world and building all kinds of new products and marketing them. And it was a great creative effort. Just as much creativity as I put into books or painting that I could put into a business. And so that, that you don't know what's going to happen at that point. So that it's a nice goal to have, and it's nice to be prepared. But go with the flow.
Yeah. Well, and that's exactly right, because it's one of those things where, like, right now I wouldn't do what I'm doing today. But like you said, that's 21 years from now. Like, who knows where I'll be at, what I'm doing, how much I enjoy it, what the circumstances might come up, all the things. So,
have you ever thought of starting a business of your own?
I mean, well, I'm kind of like, in theory, I'm kind of doing that with the YouTube channel, where I'm just trying to get this, like, build this up, see if I can end up making a decent amount of income. If I can make income off of this to live instead of doing my job, that I can do full-time YouTube. And then, I do enjoy it. I just don't have a lot of time to do it because I do work full-time. I'm also in the gym, 10, 12 hours a week, kind of thing like that. Got a kid, 2 dogs, a wife, all the things. So, I mean, I don't know. As far as like starting my own business, there's ideas that I've had. I've had a bunch of ideas. It's just like, it's one of those things like, where do you start kind of thing? And I bet you it's the same feeling that people feel with investing, right? Like when they, have their first $100 that they want to invest, they're like, where do I start? Like, where do I put this? So it's kind of the same thing for my business ideas, I guess. But the wife has her own business, so she's doing that, and I'm helping where I can with that. So.
Okay. Yeah. But as long as you're careful and you watch your expenses, like, I always have a chapter in my books about watching expenses. Mm-hmm. Watching your expenses are as important as your income.
Yep.
Yeah. There's no point in making it all and then losing it all.
Yeah, exactly. I have a video on that. Not necessarily with the wife and I situation, but like it was the choosing your path to retirement. Whether you wanted to do a traditional retirement, in your 60s, or whether you wanted to do an early retirement. And if my memory serves right, the whole beginning part of that video, the first 5 or 6 steps were all the same regardless of your path. And it was getting out of debt. It was managing your expenses, creating a budget, stuff like that. And then it was starting to get into like, what's the differences? What accounts do you use for which goal that you want to do and stuff like that. And the wife and I did the same thing when it was time to like, actually, we got married, we combined our finances. The first thing that we both did was we both wrote out all of our expenses separately. And then we went through and we highlighted the ones that we thought we could reduce or eliminate. And then that's what we did. We were calling around. We were calling our insurance. We were shopping cell phones to see if, we were doing 2 separate cell phones. What if we combine them and go to this company or that company and try to figure out different ways to reduce expenses? Like you said, I think that's actually the most important thing people do. Because I don't think, and you can speak on this for Canada folks, but like America is like, we're consumers. And I think a lot of places are consumers. I feel like a lot of the issue in America, whether it's political or actual personal, we don't have a earning problem. We have a spending problem. And I feel like that covers so many people. And I'm like, if you guys could figure out ways to reduce your spending, all of a sudden you have a lot more money than you thought you ever had because you just spend it on everything. So
I agree with you that I've got just as many relatives in the States as I do in Canada. So I'm very familiar with what they go through and how they approach things.
yeah,
And they do blow money.
it's wild when people
And of
and
course, then you get into the other thing, the whole problem of healthcare in the US.
yeah,
That, 600,000 bankruptcies a year in the US.
I
How
feel
many
like
in
that's actually
Canada?
lower than I was
Zero.
expecting. Yeah, that's wild. Okay, so I'm really curious. So you've alluded to this. So now we can stop teasing the people. So I want to know the specific, and if you can't give this away because it's it's proprietary or something, like let me just know. But just let me know. What specific criteria do you use when selecting your dividend stocks?
Um, and when somebody buys my book, they are told that they can send me an email, and I send them the the software for doing it. But also in the books, I very carefully go through in chapter probably 6 of each book how the score is constructed. Why do I do that? Because I learned when I was doing commercial risk scores and I had 50,000 clients that people trust the scoring system if they understand how it works.
Mm-hmm.
When Equifax bought out Creditel, they had all of these PhDs and statisticians and all sorts of other people come in and look very carefully at what we had done. And they saw my scoring system and they scoffed at it. They said, oh, this is not a scoring system. So they went out, they spent, I think they said several $100,000 building a commercial scoring system because they weren't in the commercial business. They were consumer business data that they had. And so then we put both of the scores together and in the same reports and gave them out to the 50,000 clients. What do you think happened? They wouldn't use they wouldn't use the statistically derived one, and they refused to use it, and they had to discard it and throw it away. I think they're still using the one I designed in my kitchen table because they didn't understand commercial businesses. They were used to dealing on consumer loans and this sort of a thing, not on commercial loans. So, so when it came to me doing what I did for myself, I know exactly what I did. And when I go to the book, it goes off and it starts off with, okay, what's the first one? Current price of stock. And it goes from 1 to 10. The first one, if the stock price scores 0 to 99 cents scores, it gets a score of 1. But it's over $100, it gets a score of 10, and so on. And it gets into the 4-year one. It does the same thing. What was the price 4 years ago? And then on the price trend, it compares the two. So the one that was, the stock has been sold for less than 4 years, it's 0. Okay, that's 0. It's less than 4 years by more, and by more than 50.50%, it's 1, and so on and so on. So it's all very closely dictated because I'm not trying to impress people with being a mathematical genius or anything like that. I just wanted to have a score that was comprehensible for anybody, even an 80-year-old woman who had never invested in her life before. She uses the scoring system. She immediately was able to use it and understand it. And that was what I was happy to achieve.
Yeah.
And every day I get requests from all over the world asking me to send the copy of the scoring system.
Yeah, I like that. I like that it's so simple that, like, I don't know if you guys ever saw those Geico commercials from back in the day where they would say, like, it's so easy a caveman could do it kind of thing. That was commercials coming around here in the US. I don't even know when they stopped those, but that's kind of the way that you wrote your strategy and how you did it. It's so simple that anybody can just pick it up, whether you are a genius from Harvard or whether you're just starting investing today. Like, you can pick this scoring system up. So,
well, I also had at the back of my mind that if I kick off tomorrow or whatever, that my wife and my children have got to be able to understand how to handle the money and what I was doing. So I was writing those books initially, not just for myself and for others, but for them.
Mhm.
I wanted them to have a guide, follow this guide, and you will be safe. And when my wife inherited some money, and she's, we did that, she set it up, and it's worked extremely well. You
Yeah,
don't
so
have to be a genius.
that's a question I always like asking when I find out people have, significant others and children. Like, do your wife and children, do they show any interest in the whole investing thing? Or is that kind of like, hey, that's what dad does, we're going to let him.
Uh, I have a son who is a chemist and computer science background, and he's got interest in it. But has he got to the point? His wife's a university professor. He's making very good money. She's making very good money, and they're not really thinking about it like they should be. And I'm not going to bug them about it. I've got another daughter who doesn't have any money, who does understand how to do it. Then another son who doesn't care one way or the other, and will never have money anyway. So,
Yeah.
I did it. I did my part of it. If they
Yeah.
don't follow it, I've done as much as I can.
Yeah. I mean, that's the way I am. So my son is one. He's one, I don't know. He's in between 1 and 2. He's not 2. I don't, when they do the months thing, that gets complicated. They're just like, oh, they're 16 months. I'm like, way to make me do math. But, so yeah, I think he's 15 months, something like that. He'll be 16 months coming up. So he, obviously doesn't care about investing, as he shouldn't. He's 1. But we have an investing account for him. I have a credit card for him. Obviously he doesn't use either one of them, but the idea is that I have him in ETFs right now for his investing account. He's just going to let them grow, at which point, say he's 10 and he starts getting a little bit of interest in it, we might be able to veer into some individual stocks. Like, I'll let him try to pick some, and then we'll look at them together and see if they're good picks or not good picks. In the in the event where he doesn't get any interest in it, we're just going to continue to build his ETFs. He's going to keep doing that. I'm going to tell him, hey, I want you to put a certain percentage of your income in these ETFs as long as you can. Like, keep going until you get real, real old. Keep doing that, and you'll be thankful that you did. So that's kind of the advice that not necessarily financial advice, because I can't do that, but the advice I allude to in some of my videos and my content is the same thing I would do, and the same thing I'm doing for my kid is where, like, if you don't care about investing at all, put it in an ETF and just let it rock. Follow the S&P 500, just let it do its thing, and in 40 years you'll thank me. Like, you don't need to have an interest, but like, it is very scary for the people that have no interest in investing at all, and then they just, they wait until they're 40 or 50 to even start thinking about it. And again, like you said, it's not ever too late to do it, but you're losing out on your 20s, your 30s, your 40s, the best years for compounding. You're losing that. So now you have to work twice or 3 times as hard as you would have had to do if you would have just started when you were 20.
But there's only so many hours in a day. And when I was working, I was putting in long hours every day. And because I put the long hours in and I was able to build these companies up, I was very well rewarded for it. Could I have spent that money and time on investing? Perhaps I could have. And would I be further ahead? I don't know. I got taken care of. I guess maybe I'm more of a fatalist than you are. Yeah, what will be, will be.
Yeah. I mean, my thing is like especially nowadays with the, like the advent of fractional shares, people can dollar cost average. You can literally have it automatically taken out of your paycheck and have it automatically invested. You can set it to where, hey, every time I get paid, take $100 out of my paycheck, put it in the S&P 500. Literally no brain power required on your end. Like, you have to set it up for 5 minutes the initial time, and then you never think about it again. Like, since that exists now, I feel like there's no excuse not to do it.
Have you ever analyzed the S&P 500?
I'm actually in the process of doing like a full review of the actually the major indexes. So the Dow, the NASDAQ, and the S&P for like a later video I want to put out.
Okay, well, in one of my podcasts, I get into the S&P 500. You realize there's all kinds of businesses that are much stronger financially than the businesses that are in the S&P 500 that aren't in it.
Mm-hmm.
And why aren't they in it?
Well, they don't meet the criteria.
Yeah, because they're foreign businesses.
Oh, okay.
There are no foreign businesses in the S&P 500. So you would have a crappy business paying no dividend, and you can have one that's 3 or 4 times as big, paying a 5 or 6% dividend that isn't in the S&P 500? In the S&P 500, I think that I did this. I think there was only a handful, like 2 or 3 businesses that ever qualified for my book because they didn't qualify. They didn't have the dividends. They didn't have the book values, and so on and so on and so on. To me, it's strictly based on the capital of the business, and that's not the greatest reason for putting your money into a stock. As I've said before, there's not that many businesses out there worth investing in. I just think the S&P 500 is just a what? It's a marketing ploy.
Yeah. Well, I mean, as much as that is, the alternative is they don't invest at all. So therefore they're losing money to inflation, which inflation's higher than normal. Or they take a risk on an uneducated guess because they don't care about investing and they just invest in whatever that they think is fit, and they're not properly diversified because they're going to put 100% of their money in this stock. And then like going back to like what you were saying about like you didn't have the time or the care to do the investing thing. Do we really think that people are going to take the time to do the research to pick a company that's not even in their country of residence because of it being so-called better than the S&P 500? Like it's the barriers to entry. S&P 500. Yeah, there's 503 individual holdings in there. There's technically 500 companies because 3 of them have splits. But like it's one of those situations where like, okay, 8 to 12%, typically 8 to 10% with dividends reinvested returns on your money regardless. Like that's kind of what it's done over the last 80 years. So just do that and let it rock. Or you can take a chance to get, 3 times that, but there's a chance you get none of it and you lose all your money too. So
what a lot of people don't realize is the hundreds and hundreds and hundreds of companies traded on the New York Stock Exchange that are foreign companies. Most of them don't realize that they're foreign companies. They're just there, and they just accept that they're there. And some of them are very, very, very strong, profitable companies. And it's just that I guess that's what you get out of my books is I've done the research through all of this. I've looked at them all, and I've laid this all out.
Yeah. Well, and the one of the things I always caution people to do, whether it's you, me, whoever, Kevin O'Leary, it doesn't matter who it is, like the blind trust that a lot of people give to other folks, like I said, whether it's you or me or whatever, I don't like that in any scenario. No matter if they're, have 74 degrees or they're a high school dropout, I don't care. To me, I feel like the people, so many people just think about the stock market as the numbers and they take the emotions of the market out of it, which is I feel like the emotions are a bigger part of the market than the actual numbers are. Because when you are out here and you're buying, like say it's something that they identify from your book that they really want to buy, but they're literally just using this. They're not understanding what they're investing in. They're not okay with the purchase. They're just like, hey, this led me to buy this. I'm just going to buy this. Same thing with me. I have a series that comes out on Friday where I talk about my 5 favorite stocks, why they're my favorites. Here's the numbers behind them. The goal of the series isn't to say, hey, Troy likes these stocks, go buy these stocks. I literally tell people in the series, that's not the goal of the series. The goal of the series is for me to put these stocks on your radar and you to do your own due diligence and you to do your own research to determine whether you like this stock, whether it fits your risk tolerance, whether it fits your goals, your needs, whatever. Because at the end of the day, when the stock goes down 5%, if the stock goes down 5%, I don't want you to sell it. I don't want you to say Troy's an idiot. I shouldn't have listened to the guy. Same thing with anything they buy from Ian. I don't want, Ian's book told me to buy this and it goes down 5%. I want you to be convinced that you like that company because when it goes down 5%, you see it as an opportunity. The emotions don't trick you into saying this is now a bad investment, even though 2 weeks ago when it was up 5%, it was a good investment. And now just because of the stock price, which me and you had talked about earlier, just because of the stock price, now it's all of a sudden a bad investment. That's not how it works. But I know from personal experience, that's what happens is when you buy stocks because somebody else told you to, and you don't have really anything else to back it up other than that's what it said, like these numbers pointed towards this, you don't have the conviction on that stock when times do get rough because they eventually will. Like you said, a crash eventually is coming, whether we want to or not.
I would say that I have much the same feeling. I don't tell anybody to buy any stock. I sort them by score. I sort them by dividend yield percent, um, and I put in the books that they can see all the history of the stock and all the details and things that worked out. And I always say before you buy that stock, you sit down and score it now to see if there's any changes. Mm-hmm. But I don't pick them. And I also said earlier that just because you have a high score doesn't mean that you're paying a high dividend. It's very unusual to see a high score with a high dividend. So, you are the one that has to make these decisions. But people don't like making decisions.
Yeah, exactly. Well, and that's the thing is they just want somebody to tell them the answer, but then they
and
don't.
I'm not going to tell them.
Yeah,
and you're not going to tell them.
Yeah, and they want somebody to tell them the answer, and then the reason behind that is because one, it's overwhelming. There's a lot of information out there, all the things, but two is because people like to deflect the blame. So if something goes down, they're like, I listened to so and so, and they made me pick this bad stock.
But that's also why I say you're going to invest in 20 stocks, not one stock, not two stocks, but 20 stocks, because you can't be right 100% of the time. And if you're wrong on a couple of them, so what? You'll recover at some point or whatever, but it's not going to be disastrous where you're going to lose your entire investment.
Yeah. That's actually a really good segue into the next question. So can you speak a little bit on your the rules that you use for diversification? So I've heard you say 100 times already, like about your 20 stocks. Where did you come up with the number 20? Do you make sure you have a stock in every sector? Are there sectors you avoid? How do you handle that?
I was asked that a while back. I said I would much rather pick a financially strong stock paying a high dividend who happen to be in the same industry as several of my other stocks than pick a stock that had a low score and a low dividend just because he happened to be in an industry that I don't have in my portfolio. I'm more interested in strength than I am in what they're doing. But saying that, I also recognize that, yes, I have picked out all kinds of stocks. There's some stocks I avoid. Because I came out of the mining industry, I avoid stocks in the mining industry. Because I know the crooks that are out there who are peddling all this moose pasture mining stocks, and I used to sell to them. So I'm not interested in those. But, it's the strength of the stock that's important. The diversification, do I have foreign stocks? I don't, because of the tax reasons. Being a Canadian, I can get 55% of my dividend income tax-free. So it's a hell of an incentive to invest in Canadian stocks. But a large number of the stocks that I own are also traded on the New York Stock Exchange, as many Canadian stocks are. All the major banks are in there. If you check out the 5 largest banks in Canada, they are considered to be, by the American publications, to be the 5 safest banks in the world, not just in here. So, I do own Canadian banking stocks.
Some of those have been paying dividends for like 200 years, right?
Oh, the Bank of Montreal was founded in 1812. It is now over 200 years old. I think it's paying right now around 6%. And, it's a reasonable buy. And there are lots of stocks like that. I have some others that aren't the Bank of Montreal type, but I've got them in there because the numbers say that they are financially strong and they are paying their dividends.
So you don't own any U.S. stocks, right? You own only Canadian stocks?
I only own Canadian. I only own stocks traded on the Toronto Stock Exchange because those are the only ones that qualify for the tax benefit.
Yeah.
But a lot of those stocks, a large number of them, maybe over half of them, are traded on the New York Stock Exchange. So are they a U.S. stock? No, but they might as well be.
Yeah, they're available here. So
because when I see 2 and 3 million shares traded a day, I'm sure it's not being traded in Canada.
Yeah, I like that. So, question on that. So you do set yourself a limit of 20 stocks, right?
It fluctuates in between 20 and 30.
Okay.
I always aim at bringing it down to 20, but keeping it steady at one number is difficult.
Yeah.
Over many years I've done it, but I don't have any more than 30
So
at any time.
do you know what your oldest holding is and like how long you held it?
Oh, geez. I'm trying to think. To be honest, I don't even look at it that way. I've got some that I've owned for a long time, like Manulife insurance company. Bank of Montreal, I've owned for a long time. I could go on and on and on like that.
What's your newest holding?
I haven't bought a stock in over a year.
There we go. Yeah.
I don't even know. I haven't sold a stock in over a year.
Yeah, so I don't even know that I got to the answer of the question, so I'm going to ask it to you here. Obviously, incentive for people to go and listen to your podcast as well. But when you are, say your portfolio is getting a little bloated, you get up to 30 stocks. How are you? What's the first thing you're looking at? Is it just your scoring system, or what's the first thing you're looking at when you're determining, hey, I want to get back down to 20. I got to sell these. I got to sell 10 stocks. How do you pick them?
If the stocks are financially strong and they're paying the dividends, I'm lazy. I just leave it the way it is. And then if I see them change, I may get rid of them. Like I got rid of a stock not long ago. I bought it at $4. It was paying about 8% dividend. It went all the way up to $24, but it never changed the dividend payout. And now it was down to about 1%. And I said, this is nuts. I sold the stock and I took that money and reinvested it back into my other stocks because I could make more money that way. And, that would be one reason I would get rid of a stock. But, I don't go out of my way to get rid of stocks. I'm not so rigid that I must only have 20 stocks.
Yeah.
If it's more than that, so what?
Yeah. Yeah. I know, I know some people that have, like Chad, my very first interview, I think he's in the 70s in stocks, which to each their own. Like some people just really enjoy it and they like collecting the good quality companies that they feel. And then I know some people that have, like I have 11. So it's not even that I don't want more, but kind of going back to what you were saying when your advice for like somebody just starting out about 5,000. When I very first started, now mind you, I didn't have a lot of money when I first started. I had 36 individual holdings and 3 ETFs. And what I found out, and this is a mistake I made, or not really a mistake I made, but a lesson I learned rather, is that I was spread so thin because I had, I don't know, let's just say $1,500. And I was spread between 39 holdings. I had no money in any of them because I couldn't. I didn't have enough money to put money in them. So like, that's one of the things that I've changed as I've gone along is like, hey, I want to have these stocks. I picked my criteria. They all met my criteria at the time. And I'm building them up until I get to a point where I feel like this is not even necessarily a full position, because I don't know what I consider a full. I hear some people say that all the time. I have a partial position in this and a full position. I don't know how people figure that out. But I have money in all these stocks, obviously, several thousands of dollars in all these stocks. And eventually when I feel like I'm at a comfortable place with some of them, maybe it's $10,000 in a position, then I can start scouting to add another addition to my portfolio. One thing I do want your opinion on, because you do have like a limited number of stocks that you like to have in your portfolio, is I have a strategy that I am implementing this year. It's the first time, so it's gonna adapt and change as it goes. But I'm calling it my active and my dormant strategy. So because I pick these stocks with my criteria, so every year at the start of the year, I might do it multiple times a year, I don't know, but right now it was at the beginning of the year, I rerun the stocks through my filters. And if you're not familiar, if anybody listening is not familiar, my criteria in order of importance is outperformance at the S&P 500 over the past 10 years. Because if I'm going to invest in individual stocks, I want them to be better than the index I could just otherwise buy. The next most important criteria is a dividend streak of at least 5 years, because I want that consistency and stability. I don't want you cutting. I don't want you not raising. I want companies that are paying and raising their dividend. And my third criteria is a dividend growth rate of between 3 and 5 years above 10%. I'm looking for compounding machines is what I'm looking for. And that's really all. I like to look at, obviously, payout ratio. Like I don't like my payout ratios like above 40%. I like that lower. But that's really all I look for. So going back to that, I used that criteria in the order, and ran all my stocks through that. I had 2 stocks, one being Starbucks and one being ExxonMobil, that did not meet the most important criteria, which means they underperformed the S&P 500 in the last 10 years when I ran my numbers. So I'm turning those into what I'm calling dormant positions. I'm not selling them because during my interview processes with my 38 other people I've talked to, one of the things I've learned is that one of the biggest regrets that people have a lot of times is selling stocks. As long as the fundamentals didn't change. There's nothing changed about Starbucks, nothing changed about ExxonMobil. Those things still do the same things that they did. Starbucks still has great dividend growth rates, so on and so forth. I just didn't like that they don't outperform the market. So I am putting them on hold. I'm letting them drip, so the dividends are going back into those companies, but I'm not adding new money until they start meeting my first criteria again. So what are your thoughts on that? Like not selling those companies, the evaluation of like the active versus dormant strategy and how I plan to do it?
I guess I couldn't answer that question until I scored both the stocks and got an impression of what they were like and looked at the history of them, and so on. But you are at least thinking about it. You're not just reacting blindly, and you're considering it.
Yeah.
And that's all you can do. Like I'm not. I remember in doing my research, like I've read every bloody dividend book that I think I could find, and then every other investment book over the last 20 or 30 years. And one of the interesting things that came out of it was one of the statements was made was that some of the best values that a guy had made on his investments when he had a stock and he forgot about it.
Yeah.
And years went by. And when he went back, he found out the thing had skyrocketed and was worth a lot of money. I've never forgotten that. And I can see that happening. It isn't the stock and the stock market doesn't have a brain in a head. It is made up of people. People are making decisions, thousands, millions of decisions all the time that are affecting the stock or the company and how people are interpreting it. Is the pessimistic and the optimistic speculators who control the share price. And they are a mob. They are not putting a lot of thought into it. They're usually chasing after maybe being rich, or they are afraid that they're going to be wiped out and lose all their money. This is what motivates the stock market. So, for you to calmly sit there and figure it out that it's not enough in there for you to decide to add more to it or leave it or whatever. You're in control. You can do what you want. You're thinking about it. Mm-hmm. You're not part of the mob. You're not a speculator.
Yeah, that's really one. I appreciate that. That's good to at least know I'm. It's one of those things where like I feel like I get like informational paralysis. Where like you said, you feel like you've read every dividend book out there. I feel like it's one of the like you can attest to this too. When you don't know anything, you feel like obviously there's things you don't know, but you don't realize how much you don't know until you start learning things. Once you start learning things, you're like, oh my God, there's so much I don't know. Like, I just thought didn't know like the little tip of the iceberg, but then now there's an iceberg. There's a whole lot more down there. Like, I don't even know. So, I said numerous times before, I get like informational paralysis where like, I'll find out about one metric that I've never heard of or this idea or this philosophy or whatever. And I'll just start going down the rabbit hole and I keep going. And then I'm like, okay, well that changes everything I thought of before over here. So like, I really try to, one thing I do feel like I haven't necessarily mastered, but I've gotten really good at is what I was talking about with the emotions of the stock market. I'm not emotionally driven in general, like not like outside of the investing. I don't like have a lot of emotions. So, it's one of those things where like that helps me in the market because like you said, when the market goes up or down or this or that, and everybody's, casting their votes of like, oh, here's going to be the next recession and this is going to crash and this bubble is going to pop and all those things. I don't care about any of that stuff. Which I just care like, hey, I think the companies I own are good quality companies. I think they're going to be worth several times more than they are today when I need the money. That's all I need. That's all I care about. Like everything else is just hogwash in the middle. Like it doesn't matter to me. But yeah, so it's cool that you say that. So I'm going to continue to learn and evaluate. And like you said, the thing that's cool about me being like my own small individual company, and every person is their small individual company, is I get to pivot and change versus like something like Google or something. Like they have to they're very big. They have to make very broad sweeping long-term decisions and stuff like that. And we can just, go with the flow. We can make the decisions and changes here and there. And I think that's actually beneficial. So, all right. So last question I want to ask you before we go today is, pretend you are all of a sudden 18 years old. You know everything you know right now, but you're 18. So the market's still the same. Everything still costs the same prices. Everything's like that. You're 18. What do you do different, or what tips and tricks do you, tell yourself going forward for the next, 80 years? What do you do different?
When I was 18, I had a net worth of maybe $10.
Nice.
Okay, so that knowing what I know is worthless because I don't have any capital to invest.
Yeah.
So the important thing then is to generate capital to earn enough that you do have something to invest. And eventually I did have the money to invest. And I guess at 18, it's nice to know that you know all these things. Like I had one of my readers is in Dubai. He has a 14-year-old son, and he spent a week vacation teaching the son with my books all about investing. And the kid was fascinated that because he said nobody at his age knew anything about investing. Of course, what's in the back of my mind is he'll have this knowledge, and what is it going to do? Because he isn't old enough to have an account. He can't open up any stocks, but he'll learn something. So I guess that's when I suggested to my reader in Dubai that he put them on that contest I talked about, where he has the play money, $200,000, because over a year, he'll see how the dividends come in. He'll see how the stock changes in price, and he'll get an idea of what it's all about and whether his choices were good or not good or whatever. And I developed that contest to help those people who are intimidated by the very idea of investing in the stock market to test and see how they could invest and how to use the tools to save themselves and to build an investment. So I guess at 18, I hope that I'd read all this and been part of it since I was 14, and I'd be knowing. And then maybe I'd feel confident on the next money I made to invest. But it is a matter of confidence too.
Yeah. Yeah, I like that. Yeah, it's the confidence and obviously the knowledge, but like the thing that separates a lot of things, especially like in speaking with you, is like there's a difference between confidence and knowledge and like just the wisdom. Like you've been there, you've done that. Like that's why none of this stuff like phases you. Like hey, you can't control whether the market goes up or down 2% tomorrow. Like there's nothing you can do about that. So you just go with the flow. You have a plan whether it does or doesn't, or sometimes it's the best plan's no plan, right? Like you just don't do anything.
I just don't do anything.
Yeah. So, I mean, I've not read the articles, but I've seen the articles and stuff where it's just like some of the best performers are, people that they're dead. They're not even here anymore. Why? Because they're not touching their portfolio. They're not messing it up. They're just letting it do its thing.
Yeah. I've read those too.
Yeah. So it is kind of wild to think about stuff like that, where it's just like, hey, it's, the knowledge, the wisdom, the confidence, like all that stuff comes as time passes. And then sometimes the best action is no action.
And also, most importantly, knowing when you've got enough.
Yeah.
We've got enough.
Yeah. And then you can tell your boss like, hey, screw you. I'm not coming back.
That's right.
Yeah. Yeah. I like that. I look forward to that day. Like you said, maybe I'm, the best job of my life and I work till I'm 70 and have all kinds of money. I don't know.
Well, don't get trapped into believing that the job you're in now, like how long have you been in this job?
I've been in this specific role for a little over a year.
Okay. So it's not long yet.
Yeah.
But, I've got a son who's been in the same job for about 25 years, right out of university. And, and I think to myself that I probably stayed with my first job too long. It does happen. Yeah. You can learn a lot by going from company to company.
Yeah.
About companies.
Yeah. Yeah, I agree. I've done that. I was with one job for I've moved to Oklahoma, and my first job I got in Oklahoma, I was there for like 6 or 7 years. And then I've been at this company for a year. So I've learned the big differences between the two companies and stuff like that. That is entertaining. It is a little scary because you're like, oh, what if I leave this company that I don't I don't hate, but I don't love it. And like you go to a next company, is it a grass is always greener approach where you're like, oh, the next company has to be way better, or it could be way worse. You never know. So it is a
Or
little
what you
scary.
want to aim for is that you get a position in the company where you've got control
Yeah.
over what you're doing for your day.
Yeah. I mean, I'm not nearly high up in my company, but I am in the data analytics position I'm in. It's kind of like, hey, we have these things you have to get done on a daily basis to get them done. Like I work remote. So I just have like, here's my task I have to get done. As long as they're done, like nobody bothers me. And I do like that part of the position. So it's not like, poking. Where's this? Like, it's not a bunch of stuff like that. Cause I don't work well with like that where it's like micromanaging, like everybody's watching every click I make. I don't do that. But anyway, Ian, I told you this would be a fun time. I had a blast speaking with you. I hope you had the same thing. Go ahead and take a second to tell people where they can find you, talk about your podcast, your books, and all that stuff. All of that's going to be down in the description below. So make sure you guys go show Ian some love.
Okay. This is the book that I developed for the American readers. It's called 106 Best High Dividend Stocks, New York Stock Exchange. Analyzed and scored. It's available on Amazon, as are all my books. And the simplest way of finding them is put in my full name, Ian Duncan MacDonald, in a Google search, and that will come all my books, the novels, the books, and so on. And also you'll get into my art and so on and so forth. The podcast, if you just put you'll also find my podcast showing up that way as well, but they're under the name Safe Dividend Investing, and I think they appear everywhere, Spotify, Amazon, and whatever. And that's basically it. I don't have to, I think I've explained to everybody at this point what my books contain and how to use them. And I'm always curious and hearing from people. It's always been interesting to me that I've never had a financial advisor attack me for what I'm doing, because obviously it's very contrary to what they do. And I often wondered why. I think I know why.
Because it
But
works.
hey,
I said because it works.
because it works and they don't know how to attack it.
Yeah.
So it's just logical, factual information that you can use to make good investment decisions. That's all I'm interested in doing, is helping people make the right decision. And that's it.
Yeah, I like that. Well, it's been a blast. It's been a pleasure. I hope you enjoyed your time speaking with us today.
We did.
And until next time, we'll talk to you later. And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.